introduce our speaker. Rich Arzaga has a skill set that is ideal for our financial wellness community. He is one of the few financial planners who can advise on and integrate directly held real estate investment into wealth building plans. This is exactly why he became an advisor. Rich is a certified financial planner, an accredited investment fiduciary, a former realtor, and the founder and CEO of Cornerstone Wealth Management. He is also a longtime adjunct professor in the UC Berkeley Personal Financial Planning Program. Rich is often quoted in financial and business publications and has earned numerous rewards for his work as an educator and financial planner. Rich, thank you so much for joining us. We are very excited for this presentation. Over to you. Rich, we just need you to unmute real quick.
Unmute. We good to go? Okay. Sorry for that. Thank you. Brittany, thank you for allowing me to share with your community today. Hello, Realtor Nation. My name is Rich Arzaga, and I'm pleased to present to you today about the ABCs of REITs, R-E-I-T-S. Here's my disclosure here. It basically boils down to we're here to educate. So you do want to make sure to talk to your professional advisors on any details on how this might impact you. Okay, so here's our agenda today. And it's going to range from the basics and numbers all the way to a few case studies. So I look forward to taking you through this. At the very end, we'll take some questions. So I look forward to that. Actually, it's going to be the most interesting part of this program is taking your questions because they're definitely more relevant to what you want to learn. So what is a REIT? A REIT stands for Real Estate Investment Trusts. A REIT fund consists of a number of buildings inside the fund. So rather than investing in just one building by itself, if you invest in a REIT, you'll actually have a collection of buildings. And these buildings are, often the type, the value that you and I wouldn't be able to afford by ourselves. 20, 30, 40 million dollars, $100 million. That's the sort of properties that these REITs buy. The REIT is managed by a collection of fund managers. They're professionally educated and trained. So these are the people making the calls for the fund. The REITs can be either listed or not listed. And we'll go into that difference in just a moment, but it basically means they can be traded or more private. Okay. The nice thing about REITs is that thousands of investors can be invested in the same REIT. And it's this scale, it's the number of people that allows the REIT to buy properties in the 40, 50, $100 million range. The other thing about REITs is that they can be very diversified. So when you have a single property and you hold it, you've got that property by itself, apartment complex, an office building, a warehouse. That's what you have. With a REIT, you actually have multiples of the same property type for the most part. So a apartment REIT might have several dozens or even hundreds of different properties that it holds. So that way you're not subject to the performance and outcome of just one property. And then one of the most attractive things about REITs is that they have very low minimums. In fact, I think the least expensive REIT to get into is $1,000. So you can actually be in the REIT investor and be in there for as little as $1,000. Okay, so I want to show you this here because REITs might be not necessarily new, but might be sort of recent to you. The REIT format, the REIT structure has been around since 1960 when Congress passed legislation authorizing REITs to be formed. So that created all this opportunity way back in 1960, back about 59 years ago. Around 61, the very first community shopping center and mall REIT came out. In 1986, self-storage was getting hot in the 80s, and that's when the first storage REITs came out. Office parks followed in 1988. Gasoline stations in 2001. Data centers, the cloud in 2004. Single-family homes became started being available for in the REIT format in 2012, and then just sort of recently transmission lines in 2015. So essentially, for whatever property type you have an interest in, there's probably a REIT for that. So it takes us to our first poll, by the way. And Brittany, if you want to bring up the first poll, given if you had $100,000 to invest in a REIT allocation, which REIT fund type, which property type would you invest in? And so there's retail, office, warehouse. Living is the same as multifamily. Our apartment complexes are living. That's what they call them now. Single family homes, a hospitality specialty. All right, so we have a, actually after a mix of above, so many of you, 46% of you would probably mix it around. And then apartment complexes, multifamily comes in second at 24%. Great. And then behind that, warehouse and single family. It's like a horse race between the two. Okay. And I don't see much retail and office, and that's really very normal. That's what I would expect to see. Okay, I think we've got all the votes in here then. Great. So it looks like a mix of the above is the winner, and I'm not surprised by that. And it's a good idea because that way you're not held hostage to one individual property type. So in that way you're diversified. Thank you, Brittany, for doing that. Let me go ahead and close this out here. Okay. So I want to talk to you about, this is where it gets a little confusing. I'll try to make it easy for you, but I want to talk about something called traded REITs and non-traded REITs and what the common traits are. And so the next two slides are more technical, but I think people get tripped up on these. And so it's good to spend some time to clarify. Traded REITs are the ones that are on the stock market. They're listed. You can actually go to Google or Yahoo Finance and look up REITs, and you'll see stock symbols. And if you want, you can actually get in them. You can choose to invest in them today, and you can get out from them in 2 days if you want. So in that way, they're there. You can see them. They trade every single day. The values change every single business day, and you can get out whenever you want. So those are the really good features on those are liquidity and ease of use. Non-traded REITs are not traded on the stock market. They do not have symbols. They are a package and they're secured in terms of the securities registration and requirements like the traded REITs, but they're just not traded every day. So on the one hand, it's not as liquid, but on the other hand, the holding period that it has offers you greater income for the most part than traded REITs. So if you're looking for income, traded REITs actually might be a better way to go. If you're looking for tax advantage income, traded REITs are also an advantage in that way because they do offer a lot more tax advantage than the traded REITs. So really is, well, one is liquid, the other is not. The real benefits are kind of distributed in terms of what you can get from each of those two. Okay, now we're going to go into the last, what I consider technical areas, private REITs versus public REITs. And I guess to put it simply, a private REIT, you're probably familiar with them because you probably have seen some of these transactions go through maybe your office. But private REITs are transactions that happen in the private market. They're not regulated or registered with the SEC. These are REITs that are, small REITs that are done by individuals or small groups, or maybe very wealthy small groups. So in that regard, they're private and you normally don't see them, and you can't really get into them unless you know somebody to get into those types of transactions. What we're talking about today are the SEC registered REITs. And those are the ones that are regulated by the SEC. The SEC has a very good filter for trying to get out the bad guys and keep in the good guys. So that's a real peace of mind for some investors. Under the SEC registered REITs, there's the traded REITs that we talked about earlier. And then there's the non-traded REITs. So we talked about that the previous slide. So one is traded publicly, the other is not. And then there's finally something called the interval REIT. which is essentially a non-traded REIT, but rather than a holding period for 5 or 7 or 9 years, investors can apply to get out of those every quarter if they wish, in some cases every month. So they offer the same benefits as a traded REIT, but more flexibility around holding period. All right. So this is we're going to go ahead going forward now, except for I think one slide. I'm going to talk about the traded REITs, but going forward, we're going to talk about non-traded REITs. So it kind of simplifies things a bit, because the private transactions, you understand what that is generally, and the traded REITs, those are fairly simple, easy to understand. So where the opportunity for income and tax advantage lies is in the non-traded REITs, although you can get those in the private. But in terms of more of a group and more allocation, diversification, the non-traded REITs actually will offer that. So they have their life cycle. The life cycle of a non-traded REIT is generally from 3 years, which is the short end, to up to 10 years. I normally see the prospectuses and they say 3 to 7 years. The reason they give themselves a range of time is because when they get to the end of that time that they have said that they would probably be liquid and wrap up their fund, the market may not be favorable. So they may want to go ahead and wait another year or two until the market is in better shape to be able to get shareholders, investors, a yield that they would be more exciting for them. The 3 cycles are: they take time in the beginning to raise the money. So this is raising money from people like you and I. Just to give you a sense, the minimums are $1,000 for the traded REITs. The non-traded REITs have a minimum of roughly, sometimes about $5,000, sometimes $10,000. And the average investment, the last number I got on this, the average investment for a non-traded REIT is about $73,000, $75,000. So it gives you an idea what that space looks like. But you can get in an IRA account for as little as $5,000. Then after they raise the money, they stop raising money, and then they stabilize the assets. And this is when the management works to go ahead and add value to the properties that they have, to secure rents, to lengthen leases if that's appropriate, whatever they can to increase the operating income, the net operating income of the properties. And if that increases, then they increase the value as well. So they work to stabilize the properties, and then at the very end, they sell off the properties. And the sales, the disposition is probably a better word for that, but the sales come in the form of either they can take that property, that REIT public, which happens, or they can go ahead and sell it off to several different sellers, or one buyer, several different buyers, or they can go ahead and merge with another REIT and become liquid that way. So that's generally the life cycle of a non-traded REIT. So there is an end date to these. Okay, so now we're going to talk about numbers. And the thing about numbers is this: we're going to talk about performance, because people want to know, well, how does that compare to, and then whatever the asset class they think about is what they want to compare it to. So we're going to take a few minutes to talk about that. We're also going to talk about the impact of taxes on buying non-traded REITs. So to help us with that, we're going to go back in time, because you never know what's going to happen going forward. Things will change going forward. But going back in time, this is a chart for different asset classes for a 20-year period ending December 31st, 2019. So I chose this chart not because REITs are the tallest column and they're at the very end and they make this point. That just happened to be a coincidence. But I chose it because it's the most recent 20-year period, which is a very good time of time frame to look at. It's the most recent 20-year period that ended in the last calendar year. So when you look at the chart, you'll see REITs did very well during that time. These are, by the way, these are the traded REITs. Okay? Non-traded REITs did similar, but they're all different because they have different funds. But REITs did very well during that time. And remember, during this time, we had a couple of crises. We had the dot-com bust, which is tough for stocks. Then with the financial crisis in 2008, which really was 2009 and 10 for most of us. So it really was a tough time for all asset classes. Nonetheless, over that rough time, REITs did very well. Gold did very well. I don't recommend that you go and put everything into gold. Actually, just is a good time for gold because everything else is kind of beaten up. S&P 500 didn't do as well as it normally does over 20-year periods. If you had a house, if you had real estate made of gold, that would even be better. But otherwise, REITs did a very good job. Check out the average investor on the far right-hand side. The average investor, people like us, not you and I. Hopefully, you weren't part of this, but people like us. Actually, their rate of return was 1.9%. It's really hard to believe, especially with people using index funds or big asset allocation, having advisors. But 1.9% really represents an investor who can't really sit still. It's somebody who panics when the market is going poor and they pull their money out. When the market's going well, they wait for it to go up, past where they pull their money out, and they buy it again. So it's a little bit of a trick. Financial behavior plays a very big part in financial success. But this gives you an idea what everyone did over the last 20 years. Good, and I look forward to taking your questions at the end, because I see there's a few up here. Okay, REITs are tax advantage, and I want to show you what that means. I want to make an assumption here for a moment that we are putting in $100,000 into an investment. I think the investments will be, one will be a note, the other will be a non-traded REIT. I want to assume a 6% yield on both of those investments, so let's make them comparable. I think that's kind of a fair shot, 6% for both notes and non-traded REITs. I want to assume that with the REIT, there's a 50% deduction because of depreciation and also mortgage interest write-off. So that factors in too, in terms of being how you're taxed. Then there's a 20% qualified business interest deduction, a new thing from a few years ago that we get to take off. Most REIT funds are eligible for the QBI. And then finally, we're going to assume no state tax for a moment because they're all from different states, but we're going to assume a 35% federal tax rate. So with those assumptions, there's our note on the left-hand side. The investment is $100,000. And then here's how it drops down. There's my yield of 6%. That means I get $6,000. I did $100,000 to make it easy. We get $6,000 at the end of a year. Well, there's no depreciation or mortgage interest write-off. So we're paying taxes on $6,000. There's no QBI write-off. So we're still paying taxes on $6,000. Now that 35% tax bracket that the investor that we're in for a moment, that's going to go ahead and cost us tax of $2,100. Okay, so what that means is that our distribution after taxes, which is what really counts, what really matters for investing is what you keep and not necessarily what you make on the top side. So we get to keep $3,900 of that. And that's okay. I mean, that's off of 6%, that's our tax rate. That's what we would get if we made ordinary income tax. That means our tax rate is essentially 35% still. And our after-tax yield is not 6% pre-tax, but it's actually 3.9%. So it knocks it down a bit. If we did a REIT, non-traded REIT, well, the first thing you might notice is in the same kind of flow chart down, you'll see depreciation of 50% I talked about. So you get to take off $3,000 from being taxed, which is nice. The QBI is another 20% on top of that. So it's another $600 off. That means that rather than being taxed on $6,000, I'm being taxed on $2,400. At 35%, my tax is only $840. I'd rather pay nothing, but my tax is lower because of the write-offs. That means that my after-tax distribution is $5,160. My effective tax rate on that investment is actually 14%, less than half of another investment like a note. And then that means my after-tax yield is 5.15%. So that's quite a difference. And most people really underestimate the value of tax benefits for real estate. They're beautiful that way. For me to go ahead and get the same after-tax yield in my note that I got in my REIT, I would actually have to have almost an 8% tax equivalent rate of return or equivalent yield rate. which is hard to do. Every single percent you fight for, you generally take on more risk. So it gives you an illustration of why REITs are wonderful that way in terms of tax advantage. Pros and cons. Okay, we're moving along. So one of the benefits of having or adding REITs as a part of your asset allocation is that it gives you diversification. And that really is a big thing, especially nowadays where the markets are so crazy. They always seem to be crazy. You don't hear real estate markets being that crazy. I mean, they have their ups and downs, but they certainly don't go up and down every single day. So here's kind of a way to measure what that has looked like in the past. This is another 20-year stat right here, ending December 31st, 2019. So it's very current. And so there's no skewing here. Look at the first circle, the circle on the left-hand side. That is a simple equity and bond allocation. It assumes 60% equities and 40% bonds. All right. So during that time, this allocation, and they use index funds for this purpose to make it easy. So they don't, there's no fees counted in this, which is a nice, easy way to do this calculation. During that time, in 20 years, the return rate for a 60-40 blend was 5.7%. And you might remember that chart that we saw a few slides ago. It's kind of similar to those numbers. If you looked at the bonds and you looked at the the S&P 500. All right. So the volatility, by the way, and I won't describe that because it's I'll describe that if you want. Feel free to reach out to me. I can talk to you about volatility. But to make it easy, you want a lower number. The higher number of volatility, the more drama there is in your portfolio. So you want it to be lower. And in this case, it was 7.1%. On the right-hand circle, the only thing that we've done is we've added REITs. We added real estate, and we only added 10% into this allocation. So we did 55% stocks, 35% bonds, 10% real estate. Okay, so here's what it did. That small adjustment increased the return rate to, historically here, to 6%. And more importantly, for some people, some investors, the volatility actually dropped significantly. So 70% lower basis points lower. So you can see historically, and hopefully in the future, that a continuation of diversification and adding some element of REITs to a portfolio can make a positive difference to many people's portfolios, and ultimately their plans to retire and to live off that portfolio. Okay. Non-correlation is described this way. It's that just because real estate goes up doesn't mean stocks go up. Just because stocks go up doesn't mean real estate goes up. It means that they're non-correlated. So the nice thing is that when the stock market is going up or when it's going down, there's a very good chance, and I have a chart I can share if you want. I can give it to Brittany, but there's a very good chance that the real estate will not follow. So that way you have different investments working in different ways, and blended together, they create a much smoother ride. The institutional part, people like the fact that these are big buildings. Now, real estate doesn't really disappear. We all feel that, or we all know that, but it's kind of nice to know that you have a portfolio with lots of tenants. And even in this COVID period, things are shifting around, but everyone still needs a place to work from for the most part. There's a lot of home workers now, but things are shifting. So institutional real estate is whether it be an apartment complex, because that's institutional real estate, or a storage or a warehouse or office. It's very nice that they are so well established and the tenants there are qualified and credit worthy for the most part. Things do happen, but that's why you have multiple tenants. So institutional investments are a lot more satisfying, especially for the passive real estate investor. The income is passive. I mean, it's truly passive. When you own, and I've done both, but when you own a building and even if you have a property manager, which I did, you're still managing the manager. And it never is really very passive. It's sort of passive active that way. but with REITs, they're truly passive. So some investors, that's exciting that they get income that seems to come out of thin air, but it's actually coming from their assets or their equity in that REIT. Other investors, they really want to be more, day to day with their assets, and so then REITs probably wouldn't be a good fit for them. The low minimums we talked about, and then of course the last part of it is very subjective, but it's very important. People love real estate. When the markets go up for real estate, people love it. They want more of it. When real estate prices go down or values go down, they want more of it because it's opportunity. So people seem to love real estate in markets, good and bad. Okay, so what are the primary risks? Well, I want to describe it this way. The primary risk is really about the investor or your tolerance for risk. So if you're not inclined to take on a lot of risk, but if you have a risky investment, that's going to be, you're going to be that 1.9% investor that we talked about earlier. Hopefully you won't be, but that's kind of what might happen. So that in that regard, if you take on an investment, a real estate investment that's not suitable for you, it may not be suitable for you. You might want to find another one. There's no guaranteed performance. For non-traded REITs, there's no quick liquidity. You can solve that by getting a interval fund and having more liquidity options, but it's not liquid. So you shouldn't put money in there that you need back. We've never had a client actually need money from a REIT that they've used because we've always scoped out well enough that they've had enough resources somewhere else, or they had enough income somewhere else, or maybe it was a pension or Social Security. We know that they can take care of their needs somewhere else, so we didn't have to force trying to do something different with that REIT holding. Okay, so since we're on risk reward and we talked about how important that is, we have a scale here, and some of you might be familiar with being asked, what is your tolerance for risk? You might have been asked that by your a financial advisor, or maybe perhaps by your accountant. But what is your tolerance for risk? And normally when people are asked that, they don't know how to express that exactly in a way that's usable. They just know what they feel. Well, I'm a pretty aggressive guy. Well, I'm very conservative. I don't want to lose my money. I mean, those are the ways that it comes out. But to really get a handle on that and to have an advisor help you figure out what's appropriate for you, these are the common areas right here on the risk reward scale. Low risk being capital preservation. You don't want to lose anything or much. There's some investment risk, to conservative all the way down to aggressive. So that's how the scale works. So the question for you, and we have poll number 2, our last one, is, Brittany, go ahead and bring that up. Thank you. How would you describe your personal risk reward style? So please go ahead and chime in, and let's see what this comes out to be. Okay, look at that. That's interesting. Okay, now we still have some time, but it looks like clearly growth of income comes in at the top at about 70–75%. Conservative is next. Capital preservation is small. Just to give you perspective, we're still getting some votes in, but I was looking at our pool of clients, or registered investment advisors, financial advisors, and we manage money, and our top category was growth of income as well. And then there's one in the middle called growth that came in second, and then conservative a third. So kind of similar. I think we had the moderate in there. It would come out very similar. Very good. Thanks for sharing that. I appreciate that. I wish I had a prize for everybody. By the way, these slides are available. Maybe that's a form of a prize. Okay, here we go. Okay, thank you for your participation on that. We do have a prize for everyone. I almost forgot. It's value add time. So here's the thing. When I asked earlier, what's your risk reward, and I mentioned that people don't know how to articulate it, recently, a few years back, a bed manufacturer came out with, what is your sleep number? And the sleep number was really intended to simplify, how you characterize how firm or how soft you want your bed to be. And so recently, a technology company has done a very nice job to help people understand what their risk number is. And the way they get to that risk number, just to build this out a bit, it's the same range right here, okay? But the way you get to that risk number is that they give you a survey, and the survey is, okay, if you have $100,000 to invest, and you actually put your own number in there, okay? If you have $100,000 to invest in REITs or anything, let's see what you would do. Would you be willing to go ahead and take then of the $100,000, $30,000 loss if you were to have a $35,000 gain? And then what would happen is you would pick one of the two. Most people would pick probably no on that. And if you pick no on that, then it would actually get easier. Well, how about a $20,000 loss for a $32,000 gain? And it would toggle back and forth. It's actually called prospect theory. And it's a prospect of this happening or that happening. So by asking you 4 or 5 of these questions that are related to your account balance, and they show you what the dollar amount is that you would gain or lose, people will actually go and pick which one was most like them. And after 4 and 5 of those, then it'll actually give them a risk number. And that risk number is associated with these terms here. And it's called the technology is called Riskalyze. So for those of you that were growth oriented, you might likely score somewhere between 50 and 90. Yes, there is overlap on some of these, and like growth and income is 35 to 70, yet growth starts at 50 then goes to 90. That's because there's some assets, there's some investments that actually can deliver growth and income sort of experience while being more aggressive. So it does work that way. You can bleed into another area and still kind of be within your zone. So the offer, the value add is, I'm happy to, Brittany was asking if we can make this available, and really happy to do that. So feel free to go ahead and email me there, and I'm happy to send you a link. There's no charge to it. You'll take 10 minutes at the most. You'll get the results back, and if you want to go over them and just discuss them for a moment, normally my first question is how do you feel about the score you got? And really, because it really leads to a discussion of more important things, but at least it gets you on the board and kind of helps you simplify this. Okay, enough of value add time. Here's another chart that might be useful for you. The chart is really all the things you might want to consider when you buy a non-traded REIT. And so if I was an investor for the first time and I wanted to have a checklist of things that I should be asking about, because the question is, what am I missing? What should I be asking about? This is a good checklist. I would use this. You probably should get all the answers on this, but you'll probably definitely get the ones that you want to know about. But these are all factors in investing, including the risk reward, as a matter of fact. Okay, so here's a brief REIT story. Warehouses. I know they're very exciting. I know it's a real snoozer for some folks, warehouses, right? But it's not as sexy as a triple net property or a large apartment complex, not as gritty as a mobile home park, or not as polished as a Class A building. I understand that. But according to PricewaterhouseCoopers, who does annual reports on real estate investments, large buildings, the warehouse industrial category actually is in a quadrant where it's slightly higher return rates than the average and then slightly lower risk rates. So if you're looking for that little edge, and I'm not saying all warehouses do this, but I'm saying as a category, they've done a wonderful job the last 20 years, warehouses. Here's a case for warehouses. The population is about 335 million, I think, something like that. In 2030, it should be 360 million almost. And in 2045, it's $389 million. So what drives value for commercial real estate is income. What drives income is demand. So they're going to go, when you have increased income and demand, when you have increased demand, you'll have increased income. and that increases in value. So the first driver is population growth, which we clearly have in the US. And by the way, you can buy global REITs too. I'm just speaking about the US numbers here for now. There's something called SKUs. You probably have heard of them. Every box of Cheerio you pick up, and there's 3 or 4 different sizes, they all have their own barcode or their own SKU. Stands for stock keeping units. That's what SKU stands for. And so every single product, but the thing is that we want more. We want more options. We just don't want those. We want the Honey Nut Cheerios. And we want smaller versions. And we want the ones that take in the camping trip with us. So every single one of them has their own SKU. And that creates much more need for storing, much more need for warehouse. Okay. And then there's a global growth where the US is still arguably, well, still is the center of international commerce. And so because of that, we need more warehouses and industrial. And then finally, there's more e-commerce, more than ever before. Probably the start of the pandemic, you were ordering all sorts of stuff to kind of, and trying to order that toilet paper, right? If you find it online, well, all that requires warehouses. So if you take a look at the life cycle of a Tuba toothpaste, and I would suggest that you get this, download the slide, and read this for yourself here. We're not going to go through this in detail, but a Tuba toothpaste, when they actually collect the ingredients and they all comes through warehouses. During the life cycle of collecting all the ingredients and manufacturing the Tuba toothpaste, and then getting it on its distribution channel all the way to your doorstep or to the store, it's going to hit about 4 warehouses. So that I like warehouses. I like apartments. There's a lot of asset classes I like, but this is the case for warehouses. I just thought I'd bring this up because it really does seem like a yonder in the very beginning. Okay, we're going to talk about 3 REIT buyers probably, and because I'm running short of time and I want to get to your questions. Excuse me. Okay, I'm going to give you examples of why these families might consider REITs. Number 1, REIT investor number 1, Mort and Betty Gage. Mort Gage, I like that name. They're retirement bound. Okay. The situation is that Mort and Barbara, excuse me. I got Barbara and Betty. Barbara's her middle name. There we go. Betty Barbara Gage. They're retiring. They have an interest in real estate. They haven't invested in it, but they do have an interest because they've been selling it their entire career and been very successful. Their income needed in retirement, including taxes, is $95,000. Their Social Security income is about $60,000. So they have a gap of $35,000. So the question is, how do they solve that gap? They're going to solve it through their resources that they have. They have $150,000 in cash. They have investment accounts of $700,000, and they have an IRA account about $500,000. So what do we do? Because we're trying to get $35,000. Here's an idea. Here's a REIT idea. They can invest $100,000 in each of 2 tax-advantaged REITs. One is a triple net at 6% yield, but remember, because of the tax advantage, it actually is like 8% tax equivalent. The other is a global warehouse REIT, which generates a yield of 5%, and the tax equivalent on that is 7%. So right there, they invest $200,000 of their $1.2 million. They've got $15,000 of income, which is pretty good for $200,000. That leaves the other $1 million that needs to generate $20,000 of income, or 2%. So a 2%, a safe withdrawal rate for retirement assets so that you don't run out of the capital. It changes, actually. It's changing with the times, but probably about 3.5%. You'll hear 4% out there. Some people will say 5%, but that's a little bit too aggressive. But if you can get it down to 2%, then that really does leave you room to take care of other life's obstacles. So the benefit of that is diversification, non-correlation, which are very important in keeping their retirement picture intact. It covers 43%, the REITs cover 43% of the $35,000 needed for only $200,000. It's tax advantaged income, and they're able to go ahead and grow the other assets and use them for income, but also life's other needs. Okay, here's a younger family. As you can see, they're younger. They have younger kids. The situation is this: Dad is a top producing real estate agent. Mom is a high earner in another industry, very high earner. They're both great savers. Okay, Mom wants to spend more time with the kids. Might sound familiar to some of you. And so the gap is going to be, gosh, to do that, how do we replace her income? Well, here's one approach. Go ahead and invest in dividend producing assets. Use their assets that they saved to produce income to make this goal happen. Okay, it could be a private note. It could be a high dividend large company stock that creates 4%, 4.5%, 5%. There's actually stocks and very good companies that produce that amount of yield. And it can be diversified income producing REITs. Okay, the benefit of the decision here of any of these three, or more likely best practice is a mixture of the three, is diversification, non-correlation of assets again. So you see that coming up often. A mix of ordinary income from those dividends and tax advantage income. Nice mix of that. More time with the kids, which is really the big thing if you think about what your goal is. Okay, here's the last one, and then we'll go to questions. REIT investor number 3, situation is this. Broker Barb Barker. That's a tough one to say. She's also a real estate producer, high producer. She's got 20 years left to work. So she already makes a lot of good income, so she really doesn't need the income. She's concerned about having 100% stocks and bonds because that's what she has, and just feels like she's too reliant on that. She can relate to real estate because she sells it. She wants to avoid active management. She loves what she does, but she doesn't want to become a landlord. Okay, and she's got some money in a self-directed IRA account. It's a SEP account, and again, she won't retire for another 10 or 20 years. Well, one approach is that she can use her SEP IRA account. You can use your retirement account to fund a REIT investment. You can split the REIT investment among 3 different REITs. And I just, let me go back here. Here it is. Different property types. She can make one aggressive for longer term, take more risk, more reward on that. She seems to have the appetite for that, and certainly the number of years. So she's able to go and develop a nice diversification from what she has and be in real estate without incurring taxes on the income. Even though it's tax advantage, she still doesn't need those taxes. The benefits are diversification, non-correlation, satisfies part of her anxiety. Some of these things, second and third ones, are really important. And real estate can defer income until you finally withdraw it. And also she has a long time horizon. So, and she can also try real estate before she retires. It's a good trial period. She can see whether it fits for her or not. All right. Here's one for your clients, but I'm going to go ahead and skip this one here. I'll leave it here in the slideshow, and you can see that if you want to download this. So let me go ahead and fast forward that. It's for Harry and Heather homeowner. All right, so gosh, we have about 13 minutes left. I hope that has helped you. And I got to tell you, the Center for Financial Wellness is terrific, terrific resource for the realtor community. I just think it's about time that you started looking out for yourself. You've done so much for others. So I'm glad to take your questions.
Awesome. Thank you so much, Rich, for that wonderful presentation. This was super helpful, just diving into this. I feel empowered to go and invest in a REIT right now.
Good. All right.
So I do want to mention one thing for our listeners. I know we do have some questions in our queue, but for those who are listening in, please note that this webinar session recording as well as the PowerPoints will be available for your review on Friday. That's right, this Friday, September 18th. Please visit nar.realtor.cffw/webinars. All right, so let's get into it. Rich, the first question that I have is, would OZ funds be considered REITs?
Would what funds?
OZ?
OV.
I'm not sure. That's how the question came in the chat.
I don't recognize OV. And maybe they can ask or clarify that.
Okay. Well, while we wait for, oh, I got it. So opportunity zones. And it's interesting. Somebody actually did mention, they said, so this is kind of a trending question that happened to come out. They said, do any REIT investment in opportunity zones If so, how would they do, especially during this time? So,
Yeah.
are there opportunity zone REITs? Are they considered REITs?
Right. That's a great question. Opportunity zones are a very interesting option. And I say that because opportunity zones are designed to help people who are getting out of their highly appreciated real estate and want to go and defer taxes on them and eliminate some of those taxes. So that's really what the purpose of it is. You would get into an opportunity zone if you wanted to go ahead and not do an exchange, for example, or not just sell and pay the taxes. So that's what opportunity zones are. As a result, they're not really designed, and by nature, they're not designed to generate income in the beginning. So as a result, there's no REITs that are opportunity zones. Those are funds, but they're not REITs. So those are two different investment types for two different investment goals. But that's
Okay.
a great question.
It is a really good one. Another one that came in, it says, how are REITs identified in the stock market? Could you just clarify
Hmm.
that again?
Yeah, sure. Well, REITs can take the form, a couple of different forms in the stock market. If you wanted to look at traded REITs, they could be exchange funds. So the REITs that are exchange funds or index funds, so they do have those. And they do have those by foreign and domestic and by property types. So there's a lot of them. Or they can be a manager who manages a fund, and they would be not index fund, but they can actively manage it. The index funds are the ones where you basically get a piece of everything. Active managers feel that they can go ahead and do better than if just going along with the averages. And they go and pick and choose, pick winners and get rid of losers, or at least not take the losers. And that's the difference between active and passive management. And the way you identify them is you basically do a search, talk to your financial advisor. If you're stuck, you're welcome to reach out to me, and I can send you a link. I'm happy to help out that way. But talk to your financial person or do a search for real estate funds, and that's how you can identify them. There's hundreds of them.
Perfect. Excellent. That was helpful. I have another one. This is going to be related a little more to COVID and everything. So, in regard to the fault with commercial real estate, how do you anticipate the commercial real estate holdings and REITs? Will they still offer, pretty good returns?
Yeah, yeah. So maybe there's two different answers to that. One is existing REITs, and the other are new REITs that are raising money. Now, the new REITs that are raising money can pivot, and they can go ahead and take advantage of this time because they're raising money and they're just buying properties. So, Warren Buffett says the time to buy is when there's blood in the street. And for some real estate investors, the fact that people are a little bit anxious or want to get out is good because then they can come in and scrape up those properties and make hay with them. So as a new investor, this could be a really good time because the fund is still raising money. As an existing investor, and we have a number of them in REITs, they've been doing okay. And what I mean by that is that nobody is creating fire sales. The REITs that we offer, that we manage, what's happened with some of those REITs is that they've cut distribution. So for a while, they're saying, well, we're going to go ahead and hold off and reserve cash. And that's the way that they manage loss. They mitigate any sort of risk they have in that REIT by doing that. And some have even come around recently because for some odd reason, things are still doing well, even with COVID and so much unemployment. So some are actually increasing their dividends. I've read that in the last couple of weeks, or actually giving special dividends, which means that they're cashing folks out for some of the shares that they own. So it hasn't been that terrible. You think it would be, but I will tell you this. I mean, COVID sounds like it's a once in a lifetime thing, but it's always something. So World War I, World War II, 9/11, the Black Friday, you name it. There's always something out there that's going to challenge the stock market and also the real estate market. And it's a matter of being able to survive your investment's worst day. And that's really what it's about. Whatever investment you have, if you can survive its worst day, then you should be in pretty good shape. All right. I hope that helps.
Yeah, no, that's a really good point. Definitely. I guess, of course, relying on the Riskalyze on where you stand
Yeah.
in that, that would help determine too on your investments. So we have a couple, another one focusing on the SEP IRA. Is it able to turn funds around and reinvest through the SEP and REITs? Is that correct? Can you just clarify that?
If I understand the question correctly, the question is in a SEP IRA, can you go ahead and reallocate to invest in REITs? Is that the question?
To reinvest through SEP and REITs, yes. Mm-hmm.
Yeah. Yes, absolutely. You can do that. You can actually if you want to invest in traded REITs, you can do that in the same account more than likely. Depends on the account you have, or you might have to switch the account, but you can still make it a SEP. So you can either do it in your same SEP or switch the nature of the holdings in your SEP and do it that way. And if it's a non-traded REIT, you would need a custodian um, who takes non-traded REITs and can make that trade for you. Not all custodians do that. Custodians are like Schwab, Fidelity, uh, Pershing, TD Ameritrade, LPL Financial, who we clear with. Um, some of them will do some of them, but not all of them will do all of them. So I think probably the best way, the best process for this is for that person to contact their advisor and to let them know they're interested. Um, Many times advisors will say, you don't want that because and they'll give a reason, de jour. Too risky. Well, everything's risky. Too expensive. Well, actually, they really don't know the price structure. REITs are actually very comparable to the other investments. So you just want to get somebody who is comfortable dealing with that to help with that. And again, if you're stuck, if you're looking for a local person, we have a big network. I can go ahead and refer it off to somebody, or I can just take your question and maybe help field that myself. I'm happy to do that.
Perfect. And I'll make sure to include again your email in the chat so that way everybody can email me if they do have any questions, or send an email to you that way if they
Sounds
have
good.
any questions.
Sounds
I
good.
have another one that came in. It says, now with the pandemic, a lot of office spaces are changing the way they're doing business and are downsizing their office space and or moving all of their employees to work from their homes. So how do
Mhm.
you see the office buildings in the near future?
It is really it's going to be very interesting. It's going to be changed a lot. But like, for example, here, I'm in the San Francisco Bay Area. Well, I can take your calls from anywhere, but I'm in the Bay Area. I'm not in San Francisco, though. San Francisco's having a heck of a time. It will have it because these leases are still obligations. But when the leases come up, they're going to have a heck of a time keeping all of its tenants. Meanwhile, where I'm at in the suburbs, not too far, I'm about 35 minutes from San Francisco, about 25 minutes from Oakland. Where I'm at, office space is getting tight because the businesses realize that it's better to have satellite office space outside of the suburbs, closer to where people want to live than it is in the city. So I was hoping that I'd be able to renegotiate my lease and actually get a lower rent, and that's not happening because there's more people coming in from San Francisco because they prefer to live out here, just like they are in real estate with homes. I've read that they're moving out to the suburbs more, and I think that it's come out in your own NAR magazine, and that's exactly what's happening there is happening with office space. Really interesting. So it should create a rise in office space for some areas and a decline in other areas. So that's what's going to happen. It's yet to be determined, but office space is certainly going to be going through some transitions.
Perfect. I have another one that says, can a 1031 exchange a real estate income portfolio, I guess, put it into a REIT? Can you do that?
I wish. The short answer is no. The longer answer is if they found a 1031 721, if you look that up in the IRS code, 1031-721, you can see that you can actually invest into a REIT, but there's very few of those out there. So just be careful. The general answer, though, for most is no, because it's hard to find those.
And just for clarification, Rich, aren't most REITs passed through to the investors and then taxed as ordinary income? Could you clarify on that?
Yeah, you're talking about REIT dividends or REIT income, is that right?
I believe that's how the question is asked, yes.
Okay. 95% of all REIT income is required to be passed along to the investor. That's what qualifies it as a REIT. As a result, it's passed along to the investor, and then it is at the investor's tax bracket. The income is ordinary, but it's offset by deductions from depreciation and interest write-off, and also the QBI I mentioned earlier. So uh, real estate income is ordinary, but there are deductions along the way that reduce it. In the example I showed you earlier, that reduce it and actually create a better tax consequence.
So are traded REITs eligible for QBI deductions?
No, they're not.
Okay.
Exactly. That's a big difference between traded and non-traded.
Got it. Okay. Is there a way to get qualified dividends from a REIT investment in a taxable account?
Yes, absolutely. Uh, yes, there might be confusing the word qualified with retirement. Uh, Qualified is just used in a different way, but yes, ironically, the best use of a REIT that's highly tax advantaged, like the QBI and also the other deductions, is through taxable accounts. If you use it in a IRA account, a retirement account, really those benefits go away because it's already tax sheltered until you pull the money out. That's a great question.
Okay. All right, that gives us our time. I know that we do have other questions in the chat, and I do apologize, we did run over, but if you do have any questions for Rich, please send him an email. It would be rich@cornerstone, WMI.com. And then now at this time, Rich, can I ask if you could share one more key point for our listeners who are taking in your last bit of advice and wisdom? What would that one closing statement be?
The one thing, the theme in the Center for Financial Wellness that I've noticed is get advice. It's a great educational platform, and it consistently says whatever you do before you do anything, get some advice. And I think that's what you really want to do. 70% of the U.S. Population, which probably means 17% of the realtors as well, prefer to do it on their own, and that's okay. There's lots of resources for that. But for those that want the help and that want a little more assurance that they're in the right direction, doing the right thing, make sure to get some help on these things. Google is fine, but I teach classes, taught class for 15 years, and I've seen students come with the Google findings that were not right because of the way they asked the question or even the thing that was on the page that they came up with. So make sure to get some help because you deserve it. You work very hard, and you deserve professional help. And that's it.
Awesome. Thank you, Rich, for that wonderful presentation. That was
Sure.
fabulous. Really
Thank you.
enjoyed it.
Thank you.
So this concludes our webinar. Please do not forget that this presentation will be available on Friday, September 18th. Please remember to register for our upcoming live event on October 7th. Rich will actually be presenting, so if you like this presentation, definitely sign up. Lastly, if you have any questions directly for Rich, I do want to let you know that I put his email in the chat. You can send him an email at rich@cornerstonewmi.com. Don't forget, you also have access to get additional resources provided to you through Right Tools right now. This is a relaunch program included to you at reduced or no-cost tools to support you through challenging times. Visit nar.realtor/RTRN to access great webinars, educational resources, and timely market reports for your business. So thanks so much for your time. This concludes our webinar, and special thanks to our members, you guys, for joining the call. Again, if you miss any part of this webinar session, I will be posting the recording on Friday, September 18th. The PowerPoint and the recording will be available for you to download at nar.realtor/CFFW/webinars. So at the end of this session, a survey bar is going to pop up on your desktop browser. Please leave us your feedback on this presentation. We thank you so much for joining us, and please attend our next session on September 30th at 1 p.m. Central. Thanks so much. Have a great week. Thank you, Rich. Appreciate
Thank
it.
you. You bet. Thank you.